About 5 months ago, when the Iran war started, the entire internet made the exact same video.
If this stays, we can easily go there. I've seen 200. We could go to these levels.
Oil's up 38% this year.
In the oil market, you have prices rising.
$200 oil, gas lines, blackouts. It was essentially going to be Mad Max. And yet, it's August, and oil is at $75 as of the recording of this video. Your lights are on. You probably paid less in gas right now than you did back in the springtime. So the entire internet was wrong, and I want to find out, will they be wrong again? Because a lot of people are still predicting that oil is going to go up. It already did go up, and now we're starting to see, even with the war still happening, it's going down. Take a look at this chart, because it's one of the most interesting charts that explains this entire story. December, oil bottoms at $58. The war starts, the strait closes, and by late April, we're at $121. And then instead of going to $200 like everybody predicted, it crashes. But what's going to happen in the next 6 months? And in this video, I'm going to answer that with actual numbers. Because over the past couple of months, it's given us a little bit of a hint of what I think is going to happen in the next 6 months. The world roughly burns through 100 million barrels of oil every single day. So that's our first big number here. That's what the world needs. Now, before we get into the actual story, we need to meet our characters. Player number 1 is the Gulf countries, and they are the faucet. Player number 2 is China, and they are the tank. Player number 3 is the United States, which holds the pump. America is now the biggest exporter of oil in the entire world. And player number 4 is the Federal Reserve. And the story that we were all told, and it was all over the headlines, goes something like this. War closes the straits. The world starts running out of oil. The price of oil goes to the moon. Sounds completely logical, right? But it's wrong in one specific way, and that's the key to this entire riddle. A shock was never about the world running out of oil. It was about oil not flowing for a period of time. It wasn't about the tank, it was about the faucet. Okay, so how much oil does the world actually have? Let's get an even bigger number. We know that the world needs about 100 million barrels every single day. Well, how much do we actually have? The amount of oil that we can get to, and for it to be profitable for these massive corporations, that means that they will actually do it, is 1.7 trillion barrels of oil. And there's something called the reserve to production ratio. Essentially taking everything that we have and knowing that we need 100 billion a day, how long is that going to take for us to run out? 58 years. People already did the math on this. And this is the other thing. Proven reserves aren't just a fixed tank. As the oil continues to go up in price, well, technology gets better, and all of a sudden it becomes more profitable to actually go and get that oil out of the ground. The US alone is sitting on 46 billion proven barrels. And last year alone, they pumped out 13.6 million a day. So the world's problem was never the tank, it was the faucet. And as we'll see in the rest of this video, that problem is pretty much fixed. Because every famous oil shock in the past, like in the 70s, was never about the tank, it was about the faucet. 1973, the Arab embargo, roughly 7% of the world's oil goes offline. The price nearly quadruples. 1990, Iraq starts a war with Kuwait. That's about 6-7% of the world's oil reserves, and the price nearly doubles. In 2026, this year, at the peak, it was around 11 million barrels a day. Every single day was shut off. That's about 10%. And sure, we spiked up, but now it's back to normal, which can only mean one thing. Somebody or a group of people built a buffer. It essentially came from 3 different countries. Number 1 is China. For years, China has been buying more oil than they actually need. And most of the world didn't actually know this until the last month or so. If you take a look at this chart here, China has more oil than almost every other country combined. It's an insane amount of oil that they're sitting on. When the Strait of Hormuz closed, China didn't panic buy. They kind of stepped off and stopped buying so much oil. Their seaborne imports went from 11 million barrels a day to about 6 million back in June. That's the lowest since 2016. The largest customer in the world essentially just stopped buying 50% of what they were usually buying. Now, the internet version of this story is that China drained its reserves and saved the world. But in reality, they just stopped buying and using so much. Their reserves were actually not really touched. Only about 1 million barrels a day actually came out of their tanks. The rest, refineries slowing down, domestic drilling has increased a lot for them. Electrical cars are going crazy in China, you probably know this. So they just stopped using so much oil. China didn't rescue the market, they just stopped showing up to it. Second was the emergency reserves. The US and its allies released about 170 million barrels. And the US has something called the SPR, the Strategic Petroleum Reserve. That's the government's emergency stash, now down to about 300 million barrels, the lowest since 1983. But it's not a giveaway to these companies, it's more like a short-term loan. Companies are contractually obligated to start paying that oil back to the US in November. And third is not really worth counting, it's everybody else's faucets, but they still played a part. Add it all up and you get what Doomberg calls the iron law of commodities. All shortages are followed by a glut. And that's not just Doomberg's slogan, that's exactly what the EIA's actual forecast is going to be. Right now they have Brent coming down to $74 this next quarter, and in 2027, down to $65 a barrel. The biggest supply shock in 50 years, and the professionals' forecast is that it will turn into a surplus next year. So the answer to the question, is oil going up or down? My prediction is that it's going to go down. It's very easy to buy into the headlines and say, it's the end of the world, oil is going to spike up. But it already did spike up, and we are already feeling the effects of that. But then this brings me to my next question. If the oil shock is over, then why does everything still feel like it's breaking? I call this next part a relay. Think of the global economy as one long wire with a surge running down it. The surge hit oil first, and oil had surge protectors, the tank, the reserves, the reroutes, so the surge kept traveling. And a surge doesn't do damage where it enters. It blows the fuse at the weakest point on the wire. So follow it. Oil spikes, even temporary, and inflation picks up. The official CPI number says we're about at 4.2%. Kevin Warsh, the new chairman of the Federal Reserve, wants us down to 2%. He literally said, word for word,
prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
Prices are too high. So he is declaring war on inflation. But then in his latest meeting, he didn't do anything. He didn't raise rates, which would supposedly calm inflation. He did nothing. People were expecting him to raise rates and nothing really happened. Ask yourself why the Fed, whose supposed mission is to get inflation down to 2%, who literally just a few months ago declared war on inflation, said that prices are too high, doesn't want to raise interest rates. It's because what's at the end of the fuse. And sure, things are going to get more expensive, but that doesn't worry the Fed. What worries the Fed is the rising 30-year Treasury yield. And for the first time in 17 years, it's hit an all-time high of about 5.2%. The last time this happened was 2007, right before the Great Recession. Interest costs are now more than the entire budget for the US military. Just to pay the interest on this looming debt clock, it costs more to pay the interest on that than it does for the entire military budget. Watch what's been happening every time that the yield goes up into bonds. We get the famous Trump taco. All of a sudden, we're in peace talks, right? Why do they want yields to come down so bad? Everyone is so scared about these bond yields going up. Why? It's because you put the Federal Reserve in an impossible position, raising rates, and now the government owes more money on its debt. And also, raising rates will cause the stock market, the one thing that people are kind of happy about, we just hit an all-time high in the S&P, it causes that to go down. And if you hold rates down, inflation will continue to rise. The one thing that the Federal Reserve doesn't want, that they declared war on. So what are they going to do? And who's going to pay the bill? Well, the thing that's going to get hurt the most is the dollar. In March, everybody asked, when do we feel this oil shock? Holy moly, oil was coming up. I remember it. You probably remember it too. It was going up every single day. And what happened? Why aren't we feeling the effects at our gas line and all these things? Well, we are. It doesn't look like 1973 with gas lines because the supply chains have already been robustly fixed over the past 50 plus years. But the one thing that hasn't been fixed and what's been getting worse is inflation. We're feeling it at the grocery store. We're feeling it when we go and buy our daily things. Because not only is the 30-year treasury yield going up, also the 10-year yield is going up. And if you want a quick recap on why the bond market literally runs our entire lives, click on the link here. The 10-year affects things like your mortgage, your car loan, your credit cards, jobs, because now corporations have to spend more money to borrow more. Even the hyperscalers like Meta, Google, Nvidia, Tesla, they're all borrowing billions of dollars for this AI boom. So right now they need as much money as they can get. But with the 10-year going up, that means that borrowing costs are also going higher, which means they don't want to hire more people, which means less jobs. So the oil shock didn't disappear. It got moved down the line, and it's just feeding more and more into inflation and putting the Federal Reserve in a place that it hasn't been in a long time. I don't think ever. Because the last time this happened in 2020, well, we all know what happened. They just printed tons of money. Assets went up. In 2008, the exact same thing, quantitative easing. But they can't do that now. They can lower rates and they can't quantitative ease their way out of this. So the only thing they can do is inflate their way out of this. And even though they're going to say, no, we're going to try to get inflation down, assets and things are still going to get more expensive. And the number one bet that we can make against the dollar that will just continue to go down and down in value is bet on real money, is bet on physical gold. This is just my theory, by the way. It's the best read that I can get from public information. You know, maybe I'm wrong. Maybe Kevin Warsh does thread the needle in the Fed and he is between inflation and killing the dollar. And maybe the Iran war just ends like that. And maybe bond yields continue to go down and the government stops printing so much money. Maybe. But I highly doubt it. Stack the gold, get out of debt, get out of this system, and I'll see you in the next one.